Hello everyone, Nick here. Answering question comes up often, should I bother protect stocks and how are options the right way to do it for me or not? Everybody's different. I'm not giving advice here. I'm just saying it like it is. If I own shares in, say, Microsoft or Apple or whatever, and I have gobs amounts of money here, let's say 50,000 or 10,000 or 200,000, it depends on everybody's different. Then if it's a big sum of money and I'm worried about it, there goes my answer. If I'm worried about it, I should look into how I can protect it. There are tons of ways to protect it. Clearly, the time to protect it was up here, not down here after the accident started. So could it go lower? It can go to 120 if what hits the fan. So sure, it can go lower, but that's not my base case. There's a good base under it, and this is not about Microsoft itself, but this is the thinking I'm going through here. So depends on the personal situation. If I know my stock and my investment is for the long term, then it doesn't matter. Over the long term, if the stocks are going to rally again in the next, I don't know, 5-10 years, what's your time frame? Then I shouldn't worry about it trying to snipe. I manage my risk by adding and subtracting my size. Some people like to get smaller as soon as trouble hits. Like, okay, I own 1,000 shares, maybe I should get it down to 500, or maybe I should double down. That is cheaper. All depends. But there are simple ways to protect a stock, either completely by doing options or partially by doing option spreads. So is it easy? It's very easy. Ask a couple questions and you will get your answer. The step one is to call a broker and get the account set up for options trading. And there are different levels there. So ask them to clarify the different levels. One level would allow you just to buy protection, like buy a put option or buy a call option if you want to participate for the upside. The other level will allow you to do a spread because that involves selling something, not just buying. So it sounds complicated, but it's very simple. It's as easy as buying a put to protect it. What does that mean? So I can say, please lock me in at 144 or 145. Anywhere lower, I want out. Here's my premium for this period of time. So I can buy one for September saying, okay, I can go to sleep knowing that my shares will not go below 145 even if Microsoft go to zero. I'm using Microsoft as an example. I could have used, what is this? Oh, typo. Apple. I could have used Google. Clearly, the bigger the ticket, like the bigger the price of the stock, the more expensive the options are. So maybe I don't want to protect it completely. Like you can see, I have an orange line here because if that line's lost, the conversation gets pretty ugly on Apple. And like really ugly on Apple. I'm not scaring anybody, but I have to be open to this. And I'll zoom out to a weekly. Now you see what the potential downside is. Okay, this is a pivot line that shouldn't fall. So anyway, yes, I can protect it completely. Say, get me out at 200 or 205. Or I buy a spread which will give me some money. So if Apple goes to zero, it doesn't protect my entire stock, but it gives me a finite amount of money that I know how much it is. So I'll say, okay, if this happens, I get 20,000. Or if this happens, I get 500. Depends. Each person is different. What's my risk? I don't want to throw too much protection. Then it doesn't make sense to be invested. So maybe I should just get out. So this is the kind of thing that, so the easy answer, protection is easy. It's more expensive now. Why? Because of this. The VIX is so high. This is the normal time when you should buy protection, if you need it. But nobody needs it until the fire starts. That's how it goes. Yet, we all have insurance on our cars and our houses and ourselves, and we don't think we're going to crash. We just need it. We know we need it. It's important. So at some point, it's important to have a balanced portfolio. That's kind of protecting. So if I have everything, all stocks and nothing else, not a good idea. Unless I have protection. What's protection? I can just protect myself throughout, but I don't need to do it all the time unless there's something on the line. So now everybody's rushing to buy protection. It's definitely cheaper than buying it up here. Now it's back to here. So there goes I can mitigate this fact by doing spreads. So okay, it's too expensive to buy a naked put, like I just mentioned. Maybe I'll buy a put spread in the stock. Therefore, I'm buying something and I'm selling something. It doesn't matter if everything is elevated. It neutralizes itself. I'm going to have the protection on hand without paying up for it. Does that make sense? Anyway, reach out if you need more details. Nick out.